tell the audience about how you got started in real estate.
Welcome to the Masters in Real Estate podcast with your host, Tanner Webster.
Do you want to start with how you got started out of college in the oil and gas business?
Sure. So I guess something I don't share much on Twitter. Maybe I talk a little bit about it, but originally I'm a electrical and petroleum engineer. I went to school at A&M here in Texas A&M here in Houston, Central Texas area, college station. And then out of school, I went up to Tulsa. I got a job as a petroleum engineer for an oil and gas company in Tulsa, and then I came back to Texas with them later on. When I was in Tulsa, I worked in the field and in the office, so all over Western Oklahoma, North Texas, Southeast Oklahoma, places most people don't ever go. And then I got them to move me back to Houston. That was around 2011, and worked for another oil and gas company when I got down here. And then 2013 is when I got into investment banking. So I transitioned from petroleum engineering into investment banking. I was helping oil and gas companies basically do deals with each other, trying to sell oil and gas assets or buy oil and gas assets. So, of course, none of this really relates to real estate, but yes, just part of the journey. And so I worked with a couple bigger investment banks here in Houston, and did that until 2018 for about 5 years.
And was it all just oil and gas related, or was it like the actual business of like oil and gas that you were transacting on?
So earlier in my career, I guess when I came out of school, I was working on the development of oil and gas assets. So I was helping to figure out where we would drill wells and how much it would cost, and ultimately what sort of reserves we would recover when we drill the wells. And then as time went on, I started working more and more on transactional parts of the business. So when the company was trying to prepare assets to sell them, or when they were evaluating targets, other M&A or A&D targets, acquisition and divestiture targets. So that kind of progressed until I got to the point in the industry where I didn't feel like I could go much further with doing that type of work exclusively. And I decided to get into investment banking because I would be doing that all the time.
Here's a dumb question. How do you even figure out where there is oil? Like if I told you I want to find somewhere in Utah and just hopefully strike oil, what's the science behind that? Or it kind of feels like people are just shooting in the dark with that.
Well, the best place to find it is where they've already found it. That's one of the truisms that you hear in the oil and gas business. The company I worked for had a big Utah position. They were one of the biggest crude oil producers in Utah at the time, which you might not even think of Utah when you think of crude oil production, but there is a pretty big basin there, and they had a big presence. Today, and it is true that you're finding oil and gas usually where it's already been found, or with the application of technology like seismic. So you're able to find subsurface accumulations, and this is how it was done historically. Was they were looking for traps under the ground, right? So they were using seismic to figure out where there might be structures or enclosures, and you can see that on seismic signatures, and you can see it. You can go and test using well logs and other drill stem tests and things like that to determine if there are actually hydrocarbons there and whether you can commercially produce them. So there's a whole investigation pattern. In the old days, it was using seismic to figure out where there were new accumulations. Today, it's exploring source rocks that are more dense, rocks that are kind of below formations typically. And they're trying to basically extract oil that is harder and harder to get at. It's in tighter and tighter rock, and so they're having to apply different technologies to get to it.
And so when you find a site that you think has oil, what are the gambles beforehand? At what point are you okay, I'm actually going to make money doing this?
Yeah, it's pretty far in the process when you figure out if you're actually going to get a return on a project like that. So the initial phase is you've got to acquire some sort of subsurface information or seismic. You might have to buy well logs to figure out if you are in an area that's actually going to be prone to producing oil or gas. Then beyond that, you've got to acquire the leases, which are the right to drill and extract oil and gas. Then from there, you're going to have to invest dollars in drilling the well, testing the well, and then ultimately putting in the infrastructure to get it out of that area. So sometimes you get partners, like you'll have what are called midstream partners. I worked more on the upstream side of oil and gas, where we were actually drilling the wells and trying to recover oil and gas. There's an entire segment below that that's midstream. That's the pipeline guys, basically. They're going to come to the well, go pick up the oil and gas and take it off site. They might truck it somewhere. They might take it to a refinery. So you've got to consider all those different parts of the value chain. And then to your question, when do you actually figure out if you're going to make money? Once the well is drilled and you've spent the capital and you've put the infrastructure in place, you get an idea of whether the well is going to produce to your expectations. So a lot of what I did was called reservoir engineering, but reservoir engineering is basically the practice of determining what the reserves of a given oil and gas well or field are. So the reserves capture both the volumes, and it also captures what sort of cash flows are going to be produced by that project. So said differently, it was oil and gas economics, right?
Yeah. And so I think that kind of leads us to your oil and gas consulting business getting started, right? When is this time frame wise?
2018. So I actually set it up earlier, kind of between a couple stints at the investment banks in 2014, and then I reestablished it in 2018. And that's when it got quite a bit more serious as far as like bringing on other staff and hiring and training. In 2018, when I left the job at the investment bank, I actually was under the misguided notion that I could just invest in oil and gas and do that as a principal investment and it would be fine, right? But you pretty quickly find out that like it consumes cash, but it doesn't produce any until the project is online. So you pretty quickly run out of cash to invest.
Yeah.
So I at that point, I guess it was sometime late 2018, I really got the consulting business back up and running as a way to, earn an income. And it started as just me. And then we hired office manager and engineers and technicians, and have trained them and kind of built the business very slowly over time. But we're mostly serving like private equity sponsored companies. We'll serve, both private and public oil and gas companies, midstream companies. We've done some work for hedge funds, insurance companies. It's kind of a broad range. We do a lot of work with banks. So we do underwriting work with the banks as they're doing lending for oil and gas. So that's a big piece of what we do.
How is the leverage on oil and gas? Like, are they? I have no idea. If you told me 90% leverage or 10% leverage, I'd say that makes sense.
Yeah. So the part of that we're involved in is assisting the bankers with more or less an underwriting to figure out what the asset is worth. And then they take it from there and they'll determine what they want to advance against that asset value. They have kind of standard measures that they use, but I would say in general, the leverage on oil and gas that's permitted today is much lower. So in the past, I would say maybe like 2014 to maybe 16, 17, you could get a significantly higher leverage, like relative to the asset value. But as time has gone on, I think that's created problems. Oil and gas is very different than commercial real estate because it's a declining asset base fundamentally, right? The wells come on at a certain rate and they drop off. And so you're on a constant treadmill of having to invest a lot more capital. It's a very capital intensive business. And so you can get yourself into situations very quickly where there's a liquidity trap, right? So if you get over levered in oil and gas, it's not like commercial real estate where you can keep punting, because the further you punt, the more the asset value will drop if you're not investing in it. So I would say if you were like thinking directionally, it'd be more like 30 to 40% leverage versus, where you can get up to 80% or so in commercial real estate or even development. I would say, half is probably a pretty good number.
Okay. Do you think you'll do like direct oil and gas investments in the future, like yourself as a principal?
Probably. I've done a bunch in the past. I would say that those have probably been equal to or maybe even greater in value in terms of equity that I've invested than commercial real estate. But all those investments took place from like 2014 through, I would say the big ones took place through about 2020. And then after that, I really haven't done as much. It's just been more reinvestment. For oil and gas stuff, it has to be really special. Like it has to be something that's really sort of a no-brainer. We're in a good position to figure out what those are as far as the deals, but they don't come around that often. We have a good network of folks that we work with, and I have operational partners that still run a business that's based in Oklahoma, and then I have a business here in Houston. And so we'll pursue deals together, but it's super opportunistic. It's not, we probably don't spend a ton of time hunting for those deals today. There's a whole lot of capital that chases that space, and it's become more and more liquid. So you've got online marketplaces, you have like a wide network of people that have capital that want to be in oil and gas. So in some ways, it's more challenging for that reason. I mean, it's relative to commercial real estate.
So I guess let's talk more about the commercial real estate stuff. You got started in was it 2020 was your first deal?
Yeah. So
what was the impetus of this, by the way? What made you say, want to do real estate?
Yeah. So not totally random. I had invested a little bit in residential stuff prior to that. I think going back to 2019, this gets into the short-term rental stuff that I'm sure we'll cover later. But, after kind of getting into residential a little bit, I wasn't that fascinated with it. It's interesting, but I felt like there was more leverage to bear and like just torque on the investment in something that was bigger, right? So, you have a certain size home that you can invest in, and you can create a rental property that is modestly successful, but comes with some brain damage. So I kind of thought, well, I have a partner in the business, in the development business. He and I started looking around in April of 2020. There was nothing happening. As you can imagine, like that during that time period, there was also nothing going on in oil and gas either. In fact, everything was dead, right? So we had a lot of free time. My partner has a day job, and both of us started looking around and said, what should we invest in? What would we be good at? And I think we came to boat and RV storage because both of us had run into problems and had seen there was a serious supply constraint in the different markets that we operated in around Houston. I had a boat and had difficulty finding places to put it. He had a boat and an RV and had difficulty finding places to put it. And that kind of led to us looking at that asset class. And then we really got in the weeds, started looking for sites, didn't know what we were doing. Right. I mean,
there was no way you could have, that's impossible.
No. Yeah. And ultimately I think we were sort of bound by our experience, right? Which was not in commercial real estate. We didn't know any brokers. No brokers knew us. And so for us, I don't think it was ever an option to seriously chase something that was stabilized, right? Because it was so competitive. So we looked around and we never really seriously considered buying an existing site for more than a moment, right? It was always kind of like, well, we're going to build one of these ourselves. So I think we started looking for land. We ran into all kinds of problems. I've written some about this, I think, on Twitter, but, we ran into every bear trap that you could run into, chasing properties that were along state highways or, in the floodplain or, had big easements or encumbrances, or were deed restricted or whatever, right? We ran into a bunch of these things. Fortunately, none of them fatal. We didn't close on a bad site yet. So the first deal, we found it on the MLS. It took a while. I think we located it in July of 2020. We ended up, I think, did our diligence over about a 4-month period, and we closed it later that year. And then we got to work. We had already done quite a bit of diligence with the county and the drainage district and other people that would be involved. And we had hired some vendors to do some work with us. We found a civil engineer who could do very light touch, like, is this possible type diligence. We later found out that like a lot of the stuff that we did on our own were things that you would normally pay someone to do.
Yeah, of course.
So yeah, we really tried to like just shoestring budget to get to the first development. And fortunately, we didn't get blown up by many of the things that could have blown us up during that process. Also, our development type, right? Outdoor boat and RV storage, it's a little bit more forgiving, right? It's not like you're building an apartment building or you're building an office and medical building or something that, you're in a city and you're dealing with zoning and you're dealing with setbacks and parking and all this other stuff. So many of those things we didn't have to deal with because we were in an unrestricted area of the county. So yeah, that became a part of our thesis too as we went.
And this is outside of Houston, right?
Yeah. So this is the first sites in the Katy, Texas area. So west of Houston.
Okay.
The second site we're working on is south of Houston. It's the nearest city would be Manville.
And is it just like free for all? You could do whatever you want, or was it like kind of restricted to a couple different uses? Like I've heard that it's a little bit easier to build in Houston for that reason, but
yeah,
what makes it easier?
So you still have building limitations, like how you have to build a structure and how you have to have floor elevations and you have to have drainage. But there are things that are more forgiving, like out in the county, you don't have a use restriction unless you're deed restricted, which you're not usually. So you're talking about converting what is otherwise going to be agricultural or rural residential to some other use, right? And either it has a house on it or it doesn't matter. You want to be kind of close to the growth, but you also, the cities don't really love this product type, right? It's not visually, it's not that attractive. And so unfortunately, like we would run into a lot of things inside the cities that created huge problems, right? Like if I've got a masonry requirement, like that's just a no, right? We're just not going to be building something with brick on the outside of it. The rents that you can get for boat and RV storage are not the type of rents you would get for retail, for example, right? And so that's our limitation is like you basically have to have land that's inexpensive, but you need to be close enough to a growing population center where there's demand, right?
Can you give us some context on what expensive looks like? Like what is your strike zone for pricing?
Oh, for land.
Yeah.
Yeah. I mean, I think once you get above about $2 a square foot, it starts to get really hard.
That is crazy.
Yeah.
That is
so
wow.
Obviously for retail, you're in a much more dense environment and you're getting much higher rents. But for our product type, especially if you're going to have any element of like outdoor storage or canopy storage or something like that, then you're going to have to be pretty sensitive on your land basis because the cost to improve the land, it's going to be heavy on site work. You're going to be doing a lot of road work. You'll have some structures. You're hoping that those aren't too expensive, but the rents that are achievable, it's not a highest and best use of land, unfortunately. So, with these developments, especially in Houston, people will drive to get to boat and RV storage. How far? Yeah. Well, I mean, we have some thoughts on that, but I think, we've demonstrated it through the first one that they'll drive out a long way, but that creates another issue, right? If in the area that we select, it's easier to build, there's more supply that comes on. So We've also seen, we've seen competitors come in. We've seen people build similar products, maybe not the exact same thing. And when we started, it was just boat and RV storage. And as we've gone, it's evolved to be also mini storage. It might evolve further to be enclosed RV storage. That was our original thesis, was enclosed RV, but it got too expensive to build.
Did you have any thoughts on so you've got a site that you are thinking you might do boat, RV, mini storage, enclosed RV storage. What was the idea behind starting with the outdoor storage? Was it just that's the easiest? Or
Well, I'll tell you exactly what it was. It was the cheapest. It was what we could get financed at the time, right? And we felt like there was a lot of demand for the covered storage, and we figured that there would also be demand for open parking because it was a lower cost option for somebody that, the communities that we're by are mostly deed restricted or HOA restricted. You can't park RVs and trailers in those communities, and they're growing, right? So every day there's new people moving in. They find out, hey, I can't store my boat in my driveway, or I can't store my trailer or my RV, or I just don't have room, right? So that really drives the initial call to us. As time goes on, I think at our first site, we've permitted a bunch of buildings, but we've only built some of them, right?
Mm-hmm.
So we're really going to just phase into it and react to the demand that we're getting and the feedback from our customers. So I think later on, maybe in this fall, we'll build another 12,000 square foot building, and then we'll just keep going until we're finished with full development at the site.
How big is the site? How many acres?
It's gross is 10. We lost an acre to an easement in the front. So we knew about it going in, but it's
okay.
tough.
Okay. So, and something that I think is interesting is you're doing all this on your own balance sheet. So you've got to finance this correctly, because similar to your story about oil and gas, you'd run out of money in real estate pretty quick.
Yeah.
And I like the rebranding of illiquid instead of broke. I think that fits my narrative really well.
Yeah. Right.
So how do you do the phasing on this? You do 10 acres, and are you doing the first 3, the first 5, first 2? How do you think about that?
Yeah. So the first phase, we covered up about 8 acres. And when we did the first phase, we also did the detention. So we did all the site work and the fencing on 8 acres. And then in the second phase, we came back, we finished the last couple. We fenced it, created a bunch more parking, and then we put the 2 mini storage buildings in. So those have been the only 2 phases so far. The challenging part is, as you can probably imagine, when you do the first phase, you're doing the site work for everything.
Yeah.
So you're kind of spending a lot of money up front to a lower yield on the first phase. And then every incremental phase should be much higher, build your yield on costs up to a point where that's acceptable. So I don't know what the actual numbers are. I'd say maybe our first phase got built to a 6% yield, and then the second was 8.5 gross weighted, and then the third might be, 11 or 12. But you could see where it could eventually snowball to. You have to be very careful about how you're financing it. On our first phase, it was just traditional bank financing. It was 80% loan to costs, construction financing at the time. And we went through the brain damage of attempting to do SBA 504 financing. It was awful. It almost prevented us from building, to be honest with you. It was so bad that at the time, it was the summer of 2021, and our materials costs were changing daily, right?
Hourly.
Yeah, hourly. So the steel prices were going up, and then later, concrete prices started going up. So we had to go from what was going to be a fully enclosed boat and RV storage facility on concrete. It's going to be beautiful, and we de-scoped the whole thing. We just said, what cost can we cut out of this project to get something that we can build, and that our bank will support, and that they trust us to operate, right? So it really, you call it value engineering, but it was almost completely changing the nature of what we were going to build just to get something done. And I don't know. I don't really know how close we came to not getting that off the ground, but from the time we closed on the land in November, we had tried to get permits. Well, we got permits pretty quickly in February, but then it took us another 4 months to attempt the SBA 504. That fell apart. So we didn't end up closing the construction financing until September of 2021. So if that gives you any idea of it was pretty rough.
Yeah.
Now, subsequent phases have been much easier, both with the bank and with, our partners and contractors and vendors. They've seen that we built the first one and, they say, well, hey, you can probably do it again. And we trust you to a certain degree to not mess this up.
Yeah. How does it work with the phasing financing wise then? You do the first, call it 8 acres of the 10 acres, and you're borrowing at 80% of cost of that. And then the remaining acreage, are you getting a whole new loan, or are you just is it a revolver? How does that work?
Yeah, we just stacked a second construction loan on the first one, same bank. And I probably shouldn't share what we got relative to what we invested, but it took us to a higher weighted loan to cost because we were able to reappraise the first phase. We had already leased it up. So the bank was a significant partner to us in the second phase expansion. And, for us at the time, it made a lot of sense. The interest rates made sense. We were able to lock for, I think the first one was 6 years. The second one was 4 years. And so those, they roll probably in 2027 or so. And then they just...
Hopefully rates are lower by then.
Maybe, yeah. Our hope is that by that point, we would have done 3 or 4 phases of expansion, and whatever the pro forma debt yield that we have at that time will be, hopefully higher or whatever we can get up to. But we're still stabilizing the mini storage, and the parking and canopy storage is mostly full at this point. So each part of the project is in different stages of revenue management, and that's just a very long-term game. You have to kind of zoom out away from it. You can't. I get down in the weeds because we self-manage, right?
Yeah.
So for me, I'm in it day to day, and I see the leases come in, I see people move out, and I see kind of the financials as we're rolling forward. But it's just it's like a long-term war,
Yeah, exactly. And how much of this time are you spending on the real estate business versus the oil and gas? Is it 50-50, or is it just more like a side hobby?
I kind of break it down. I spend more time on the real estate development now than I have in the past. And it's become a majority of where I spend my time. I think you have to pay attention to these investments. Obviously, they're not something that you can just set and forget. And for us, because we don't have a plan, it's an investment build model. Invest and hold is really kind of our whole strategy. So I think what I hear a lot, or I see this I think on Twitter a lot, is more of the merchant development. This is my yield on cost, and this is the market cap rate, and I need to have some spread between them. We think about it more like, what's my long-term financing costs, and do I have a sufficient spread to that? If I think that my long-term financing cost for the asset that I've got is a 6 or 6.5% interest permanent loan, well, then we probably need to be building to a 10 yield on cost or 11 yield on cost, in my opinion, for the risk.
Yeah.
Or perhaps higher. We usually have a higher target than that, but if we can't get there, then we need to make sure that we have the right financing options to have it set up permanently.
Yeah. Do you think you'll always use the banks, or do you think you'll venture out into debt funds, or maybe try SBA again, or do you think that's kind of where you're gonna stay?
Yeah, probably no with the SBA. Unfortunately, they're too slow to mobilize for what we want to do, and really for, I think, what most ground up developers are trying to do. If your cost situation is dynamic, they just don't work. Too much paperwork, too much brain damage, and there's a lot of fees involved in it too. A lot of people don't talk about that, but they're trying to reach for the next 5 or 10% equity, when really they would be more well served to just move faster, right?
Yeah.
Because if you think about it, if it delayed us 4 months, it could easily delay you 6 or more months. And, I think a lot of people, they gloss over the difficulty of getting approved in those structures. You're not just dealing with the bank, you're dealing with the CDC and the SBA, and it's not an easy process. Just for the extra 5% equity that you don't have to put in. And so I'm not really convinced that we would ever do that again for development. To your other question on debt funds, we like the partner we have with the community bank that we're working with. Until they, demonstrate that they don't want to do work with us, we'll keep working with them. Like
Until they get purchased by JP Morgan or something.
Right. Yeah. Hopefully they're out of the line of sight of some of the bigger banks. But, it's become more difficult over the last 2 years to work with regional banks. I've had relationships with different regional lenders, and the deposit requirements have gone through the roof. They've constricted what they'll loan on construction, which is, I think totally reasonable. But if you have a relationship or you can form one with a community bank, I really do think that is I'm not going to call it a cheat code, but I think as a developer,
Call it a hack or something.
yeah, sure.
Yeah.
I mean, you really need that relationship, and you need them to trust you. And if their loan rates are, 75 basis points above the next guy, I would still take them. I just, they're that easy to work with. And longer term, yeah, when we stabilize the facility, maybe we need a permanent loan that has a permanent rate, right? And but we have to finish building first, right? We have to finish expanding. So we're not there, and at the first site or the second site.
Yeah.
So I think we're comfortable where we're at now, because those loans are like I call it like the bumper lanes at the
bowling alleys.
Yeah, they keep you out of the gutters somewhat because they're fully amortizing loans, right?
Mm-hmm.
The only thing that floats is the rate floats after whatever
Term, like 5 years or 7 years or something.
Yeah.
Yeah.
So that
Okay.
Yeah.
So are you just working through your existing deals, or are you looking for active deals now? Like, are you trying to find more sites for this, or what's the game plan?
So we have a second site that we closed on in March. It will be more light industrial, we think. We looked at it for storage, actually, and that's kind of why it popped up on the screen for us. But it's a bigger site. It's almost 2 acres bigger than the first one. It's in another area of growth, and while we think it would work for storage, I think what we've seen is that that site had a structure on it. And so we were able to get a free look at the leasing demand of a 4,000 square foot single tenant building before we closed. Mm-hmm. And we put it under contract. I think it was like late last year, late in 2023. We leased it a couple weeks before we closed. We leased the building, and then we closed it in March, and then we've been improving the site, getting power there, getting a water well drilled, and doing some other improvements that I think that'll make it more attractive to the tenant that's already there, who already signed the lease, and in addition to anybody that we want to go replicate that building or build some additional single tenant buildings out there. So It's a big site, and I think the main constraint is going to be equity, right? Like, if we really went ham, we could invest, $6, $7, $8 million out there. I mean, it could be big. It's just, how quickly do you want to do that, and how much leverage do you want to take on? So we've explored partners a little bit. I think we're still kind of early in that, exploration of outside equity. But
yeah, do you think your strategy would change at all with outside partners? Because 80% leverage it's pretty high. Like, do you think you would still do 80% leverage and just bring in partners for the rest, or would you maybe taper back the equity or taper back the debt and bring in more equity?
Yeah, I mean, we've thought about it a little bit, and so I'll speak for my partner a little bit here. But if we were raising equity, the idea would be to do a little bit bigger build at the same time. So I don't know if that looks like 60% loan to cost or 55% loan to cost, but we would back the leverage down a little bit. And try to raise a bigger chunk of the deal and do a bigger build too. Like we wouldn't want to piecemeal it like we've been doing with the phasing, because the phasing really just lets us stretch our equity a lot further and retain all the ownership, right? So if you're raising money on the front end, you've already kind of said, well, now I'm scaling, right? I'm trying to scale, and I need to get the benefit out of that, right? The last thing you would want to do is build a project that's too small with partners and you don't get any of the benefit, right? So
I've done that. It sucks.
Yeah. Well, yeah, and so I think the other thing to say here is we take the responsibility that comes with raising money very seriously, right? Like you're a fiduciary for someone, you're going to have to report to them, you're going to have to walk them through your investment thesis, and then you're going to have to be accountable to them. So that's something that we take seriously and not something that we want to just jump into without a lot of preparation. We also have to have a project that makes sense, even with leverage, right? So if we're trying to get bank debt and the interest rate's too high and we can't get positive leverage on it, we're not in a position to play the game of building something and then trying to sell it, right?
Yeah.
Said differently, like our permanent build investment build model still has to work, right? If that doesn't work, we're not really in a situation where we would want to become merchant developers, I guess is the best way to put it.
Do you think that's more risk, or is it just like you don't want to pay taxes, or like what's the reason that you don't want to be a merchant builder at all?
I just don't think it's that consistent with like the input of construction management and other things that we would need to have to like develop an advantage, right? So, and going back to your other conversations in the past, what is the advantage? It's that I'm self-performing my project, right? I'm building to a higher yield and I'm able to sell into the market. If we felt comfortable that we could build our own projects, or we could at least direct subcontractors, and we could spend more time doing that, I think that would give us the type of advantage that we would want to have before we got into merchant building. That's just my own opinion. But without that, and especially if we're leveraging general contractors and assuming for a minute that our basis is a little higher as a result, I think our preference is that we would want to still be postured to like do permanent hold investing.
Okay. So you've written a lot about like land due diligence, and you've kind of learned it the hard way, just like me, through like burning money. And so I think it's the best way to learn it. So let's take kind of a sample deal from A to Z. Maybe the next deal you're chasing. How do you think you're going to find it? Do you think it's going to be a broker? Are you doing MLS still, or do you think you're going to send some mailers and try and find it? How does that look?
Yeah, I don't think we'll ever be in a position to chase like I'm not going to say off market, but do like a mass mailing campaign or something to find these sites. And part of that is like that it requires you to set up an infrastructure to invest in the people that can do it or the materials, and then hope that you can get an outcome from that by buying, below market value land, right? And I don't think that our model really depends on that. Like we can find good deals. They don't have to be,
huge discounts.
They don't have to be a steal. They need to be something that has the potential to have our value add applied to it and not be a crazy high basis, right? But if it's in our strike zone on, like for instance, if I found land that was 50 cents a square foot, would that work? Well, maybe, yeah. I mean, it could, but you still have to have the right demand and demographics, and you need to have the right product that is a fit. So the land ends up being a minor part of the whole thing over time. But the last thing you want to do is buy something too expensive and then have to sit there and pay on it. So we've been lucky. The last two deals we bought have been straight MLS buys. They were listed under farm and ranch listings, or they were listed, but they were not cross-listed on commercial platforms. And
those are the best ones right there.
Yeah. I mean, again, when we see it now, we know what it looks like, right? So let's say you find a deal, you think it's interesting, it has the right setup and it's the right size, configuration and everything, and your desktop screen works out, right? It is situated in such a way that it's maybe it's by the population centers, or it's on a good high traffic road, or it's got flat topography and doesn't have a bunch of water features on it. Okay, it's checked out there on your desktop screen. You can approach through the broker, or, obviously, if it's listed, that's the way that you would want to do it. In the past, we've self-represented on the 2 deals that we had. And
Yeah.
It makes it a little easier. There's a little less friction just to go straight to the seller's broker. If we were doing more deals and higher volume, we would probably want brokers on our side as well. But because the volume is so low and we only need to do one of these deals every 2 or 3 years, it doesn't warrant building out the infrastructure to do high volume marketing, right?
Yeah.
At some point in the future, if we were to say, hey, we want to raise outside investment and we want to be able to do this in 4 or 5 different locations around Houston or another market, then yeah, we would need help from brokers. We would need off-market sourcing. But for us, it just hasn't been necessary, at least to this point. But yeah, you find the deal, you step in, you start doing your diligence. The first thing I'm usually looking for is restrictions, like easements, encumbrances, CC&Rs. Like, just are you able to build something on this track? Is it in the right municipality, and do they care what you build? Do they have ordinances that apply to you? That kind of stuff is the first screen.
And are you just calling a title company and having them send something over, or how do you look at that once they send it over to you?
Yeah, so you can either do this pre-contract, which we've done in the past, or you can do it right after you contract with somebody. It should be the first thing that you do, right? So you need to get a full title record search, and you need to reveal whether there are going to be things that are not covered by title insurance and what they are. So that's in the schedule in the title insurance commitment. And if you get into that schedule and you see, hey, there's a deed restriction, or there's a property restriction that says you can only build residential, or you're limited to certain floor area ratio or something like that, you need to sniff that out like right away before you spend any other money. So it's the first thing I usually wait on, and I don't release anything else until that's finished. There are times, I guess, if you're in a competitive situation, you might be able to start your environmental at that time too. Usually we need, I'd say 4 months plus a 2-month extension to get these deals done and to feel comfortable that we've done our diligence. So that, I mean, if you just call it 6 months to close, that's usually pretty good. And you don't find a lot of pushback on that. I think the first one we did 4 months, and we were able to get everything done in 4 months that we felt like we needed to. But, with the second one, I think we extended it just to be able to see if we could lease it before we close. And so we were able to by a couple weeks, but, so you can always learn more things. If you have an extension, you can get a little bit more time. I think in more competitive environments where there's people competing for that land, or maybe you're in a downtown area and there's retail buyers, you're not going to have that flexibility like we do. Just because it's so hotly contested, and, there's a very liquid market. Whereas for our use, I don't feel like the market is all that liquid. It's not super transparent. Texas is a non-disclosure state, so you're not getting, seeing real clear land comps either. That has been, it benefits us, but at the same time, you're really trying to solve for what your development's going to be on that site, and not so much worried about, like, am I getting the best deal on the land itself, right?
Yeah, I think the land's more of just a plug figure, right? Like, you can't really move your cost by 60% either way, so you get like a pretty good idea of what you can pay for the land pretty quickly.
Yeah, and what's it going to cost you to cover, whether it's debt service, which we don't try to lever land like intentionally, but if it's part of a broader development, then we will, right? And What's it going to cost you to cover that? Do you have the ability to service that over what duration? Like what we look at too is, hey, if we're going to phase the development, does our initial phase kind of coverage, cover our debt service? Can we get a certain yield on that and feel comfortable about it? And if so, then that's fine. It allows us to open up and look at other options for the development, site planning. And do we want to have a mixed development? Do we want to split the site up and do a couple different developments because it's so big? We've looked at that on the second one because it kind of more naturally sets up for that.
So back to the due diligence. So you start with a title report, and then are you doing phase one after that immediately, or how does that work?
Yeah, usually right after that, you're going to come in phase one, and then depending on how quickly that can get done, you'll release a survey, an Alta survey also at the same time or right after. If you're really concerned about what's on the site, or you're not sure if there's been environmental issues, you just go to do the phase one and you wait on the Alta, because it could be a little bit more expensive. And phase one, a couple $1,000, $2,500 is gonna solve that for you and tell you if there's something to be concerned about. And it can also save you a bunch of money down the road on surveys. I had one in 2023 that I looked at. We screened it. I did a phase one. That came back with problems. I did a phase two on it. That had some serious problems. And then we, cut bait at that point. But
what was the use on the site? Like, what made you think that it was contaminated? Was it just like was it a former gas station or something, or what was it?
No, I've run into a few of these now and different causes, but auto use, auto salvage, transmission repair, anything that relies on or would release hydrocarbons, solvents, painting outdoors, sandblasting. I've run across a bunch of different uses that can create problems. You can even see it from agricultural type uses, pesticides and other things that are chemicals that can be released. And, whether those were an issue or not, it'll be revealed if they're going to be a condition on the phase one, and then whether you need to test it. That starts to get into like cost sharing with the seller, right? Oftentimes you'll see that they don't really want to find out if there's something wrong with their property.
Yeah, of course not.
It's quite a game that you can play with them. But I would say, like, the lesson I've learned over the last couple of years is if you get phase one that comes back with like real recognized environmental conditions, first thing to do is probably just go talk to an attorney, like an environmental attorney, like somebody that deals with these every day, to tell you how big of a problem you have. Spend the $1,000 to get their opinion. And then if it's a small deal, I would cut bait. Like, if it's a bigger deal, or you think it can be a major investment for you relative to the cost of the land, you might consider doing a limited phase two. And, if it reveals something, then you can expand that, or the seller can pay to expand that. The last thing I think you want to do is go poke a bunch of holes in the ground and spend a bunch of money, and the seller already knew that it was contaminated, or they knew that there were problems. So you have to be really careful with phase twos. I think most people hear that and they think, oh, gas station, right? I just go and I poke a couple holes and it's a few $1,000s. It can quickly get out of hand, especially for bigger sites. Like I had one last year. I think we did 13 borings. I mean, it was like $20,000, right? So it's a quick way to vaporize money. I would be real cautious of doing that again. You have to, the price has to be worth it, right? This is why properties with environmental problems, you don't trade, and especially the small ones, because it's just not worth the headache. I've also got a little bit of experience sort of chasing down like the state programs and trying to get owner liability. And to remove the property from any kind of future action that the state agencies might take against it. But it's a long road and it's expensive, and it's not for first timers. I wouldn't try to do it if I was a first time developer.
I don't even know if I would do it if you're a seasoned developer. It almost feels like you need to have a specialty. Like we had Damon on the show a couple weeks ago, and he had like a serious background in brownfield redevelopment. And I feel like you almost have to do that. Like you either, that's all you do or you never do it. So
Yeah,
word of caution
probably,
to all of our listeners.
it's probably pretty binary, frankly, and you're right. And I think the only like heuristic that I came away from that with was really, if the site is too small, it's simply not worth chasing. If the prize is big enough and what you're trying to develop is big enough, then it can, the cost of the environmental remediation or even just the testing could be small relative to what you're doing. And the place I see it done the most is industrial, because the use in industrial was probably previously something that would be criticized, and the development might be huge, right? It might be a 100-acre site. So, are you going to let a phase one condition scare you away from that? Or are you going to go through a phase two and you have a lot of money behind you? Then yeah, you can probably do that, right?
Yep.
It's just part of your pursuit cost at that point. But I think for me and for anybody else using their own capital to do development, it really doesn't make a lot of sense at the smaller scale.
You're doing all these deals. How do you get from deal to deal? Like if you don't bring in outside money, are you just trying to get the oil and gas consulting business to just churn out more money that you can directly put into real estate? Or how do you think about kind of going deal to deal on your own balance sheet?
Yeah. And I know for your listening audience, I'm 39 years old. So I've been working a while, and was in a good job before, and then eventually banking, which was another good job. So it took me a while to develop like any kind of balance sheet at all. And then, the other thing that I kind of figured out is that if you don't have an outside source of whether it's fees or outside income or something to tide you over, you're going to be paying for the interest reserve, right? You're going to be funding it out of pocket. So number one, I have a partner, a 50-50 operational partner, and he and I are both equity funding the deal. So we have to do personal reserve for interest, right? We have to think, all right, for a year and a half or 2 year lease up, this is going to be the interest spend, and this is going to be the operational spend, and here's our outspend, and do we have enough reserve for that? So up until this point, it's basically been that outside funding coming into the business to make sure that it can sustain up through a lease up, right? And for anybody, getting into development, I think a lot of us when we've been out there talking about it, like having an outside source of income is really important. I kind of got into this in 2018 where I was making investments in oil and gas and quickly realizing, hey, this is negative free cash flow, and it might not get to positive for 18 months. And in the meantime, I'm just going to be drawing down on savings and drawing down on cash. So I think that's imperative. Like if you're independent and investment building model, which you're not selling, right? So there's no liquidity event or refinancing. In this instance, there's no liquidity event. You need to have an outside source of income. If, on the other hand, you're a merchant developer, you might have a liquidity event. You might even have partners who are paying you fees, right? So that can be a source of income. And I'd argue that probably that might even be more challenging than what I'm doing, right? Like getting investors to trust you and then having them invest in your deal and pay you fees that can support you, right? So I don't understand that struggle personally because I'm not doing it that way, but I can appreciate how hard it must be. Like,
yes,
it's, not having outside capital, it cuts both ways. Like we obviously don't get the benefit of promoted economics, and we don't have the support of capital partners to scale our developments. We also don't have the support of their fees, or just their general guidance and partnership. So there's a lot of downsides to doing it yourself. And I think, a lot of what I've talked about on Twitter, at least to this point, has been like, hey, this is what I'm doing and this is what I'm building. But like, you don't see in the background that there's a whole infrastructure of other businesses that have supported this for the last 3 or 4 years. I don't talk about them as much, and it's really important to, like, I guess if there was a takeaway, that would be that would be one of mine. Is like it's not a business model that you can really pursue absent something else, right?
Yep. So where do you think you're headed over the next couple of years? Do you think it's more oil and gas or more commercial real estate? Like, where do you want to be? Like, if you could just snap your fingers in 5 years from now, like what does that look like for you?
Well, I mean, I'd say that our hope is that we can get a couple, 3, 4 of these larger developments off the ground and funded and through their investment cycle and stabilized by that point, right? So, I still, though, I mean, I've made big commitments to growing the oil and gas consulting business as well, right? So, alongside the growing investment business, I have a growing operational business that I have to, I need to attend to. I need to ensure that my employees are taken care of and that they have responsibilities that are growing. We have a growing base of clients that we work with on that side that still trust us to do good work. And so I'm committed to both, really, frankly. And I think, it starts with the consulting practice because that's the one that's operationally a little bit more intensive. It has employees, and I have obligations to make sure that they are taken care of. So
yeah,
that's something I committed to do a long time ago. And ultimately, I think that has to come first. These investment businesses actually have to, they have to be supported. Once you make the investment, you have to support it through the full cycle. So each time we look at something new, you make an investment, you have to support it through stabilization. So if you can't do that or you can't commit to that, then you shouldn't get into it. That's sort of how I feel until those businesses can sustain themselves, right?
Yeah.
So 5 years from now, maybe a few of these sites may be finished,
Yeah. I think we'll leave it there. Andrew, this is great. Thanks, man.
Yeah, it's been great. It's really good to see you, Tanner, and thank you so much for having me on.